magnificent, 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 magnificent.
In the last episode, we covered options, but there's something very powerful that can influence almost any strategy, and most investors aren't even aware of it. Investors don't interact with the market. They interact with their interpretation of it. That's a core theme in Hyun Kim's book, The Psychology of Stock Market Investing. The market you experience is filtered, shaped by bias, emotion, and whatever signals are most visible. Price is the result of behavior. Behavior is driven by perception, and perception isn't stable. Once you see that, manipulation becomes easier to understand. It's all about shaping perception and letting predictable behavior do the rest. The distortion starts with how information is processed. Investors anchor to historical prices. Availability bias pulls attention towards whatever just moved or whatever is being talked about. Confirmation bias filters out anything that challenges the current view. Over time, a narrative forms that feels coherent. The chart, the story, and the conviction all line up. Kim's point is that this internal version of the market feels real, but it often drifts from reality. Once that perception feeds into decisions, behavior becomes predictable. Overconfidence increases activity. When investors feel like they understand what's happening, they trade more with more conviction. That illusion of control reinforces the idea that outcomes reflect skill. When things go right, it confirms the story. When they go wrong, it feels temporary. Investors become most aggressive when uncertainty is actually highest, and emotions amplify it. Losses carry more weight than gains, so behavior shifts under pressure. Positions that should be exited are held. Positions that are working are closed early. Capital flows away from strength and towards weakness, not strategically, emotionally. When these behaviors scale, they become structure. Investors look to others for confirmation. Narratives spread. Behavior synchronizes with coordination. Price begins to move on reactions to other reactions, and the market becomes a feedback loop. This is where The Little Book of Market Manipulation by Gregory Durston and Ailsa McKeon adds clarity. Manipulation rarely looks like fraud. It looks like a signal. If behavior is predictable, you don't need to control outcomes. You need to create or amplify something others will respond to. A move that looks like momentum, a narrative that fits existing beliefs, a shift in order flow that suggests something is happening. Those signals show up in three places. Information is framed, not fabricated, framed. Emphasis, timing, and narrative shape how facts are interpreted. Retail investors are especially exposed here because most inputs arrive pre-packaged through headlines, media, and social platforms. By the time information reaches them, it often already carries a conclusion. Order flow is mechanical. Visible orders and short bursts of activity can create the appearance of demand or momentum. Retail reacts to this layer indirectly through price, often interpreting movement as confirmation rather than a starting point. Positioning ties it together. The trade is built first, then conditions are created where the market is likely to move in that direction. If enough participants are already leaning, it doesn't take much to tip it. Small moves cascade as others react, hedge, or chase. Retail sits at the end of this chain. Decisions are often made after signals have formed, narratives have spread, and positioning is already in place. This is where awareness becomes useful. Narratives simplify complexity, which makes them powerful. They help investors process information quickly, but they also make sentiment easier to steer. Communities can rely on more informed participants to interpret what's happening. That influence can be constructive or abused, and from the outside, it usually looks identical. The difference tends to show up when the narrative's tested. In more stable environments, disagreement improves understanding. In more fragile ones, it gets pushed aside. When a narrative becomes central to how a group makes sense of the market, challenging it can feel like destabilizing the entire framework. At the same time, judgment tends to drift towards extremes. Some investors assume the best without much evidence. Others assume the worst just as quickly, and both make perception easier to influence because they reduce the need to evaluate information carefully. More independent thinking sits somewhere in between. It holds competing possibilities and updates as new information comes in. That's less comfortable, but it's also less predictable, and predictability is what most influence depends on. From the outside, it's hard to separate cause from reaction. Much of what moves markets comes from framing, timing, and signal creation, things that blend into normal activity. That's also why mispricing can persist. Price is always a mix of value, perception, and pressure. Value moves slowly. Perception can change instantly. Pressure builds when positioning leans too far in one direction. Most short-term moves come from perception perception and pressure, not value. And perception is where influence lives. So the goal isn't to decode every signal or to spot every instance of manipulation. It's to recognize when your interpretation might be shaped by a narrative, a move, or the behavior of others. Because once your reaction becomes predictable, it becomes tradable. The more independent you're thinking, the harder it is to influence your behavior. So don't just react. Make decisions. Like, subscribe, follow at The Magnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.